Look, I need to show you something that's happening right now in the gold market. And if you're over 55, this isn't just another market story. This is about your retirement, your savings, and decisions you might need to make sooner than you think. 3 weeks ago, something unusual happened at the COMEX. The amount of physical gold available for delivery dropped to levels we haven't seen since 2001. We're talking about a 78% decline in registered gold inventory over the past 18 months. Now you might be thinking, so what? Inventory goes up and down. But here's what makes this different. At the same time this inventory was draining, something else was happening. Central banks around the world bought 1,136 tons of gold in 2022, then 1,037 tons in 2023, and in just the first half of 2024, they've already purchased 483 tons. These aren't small countries hedging bets. We're talking about China, Russia, India, Turkey, Poland. Major economies are accumulating gold at a pace we haven't seen in over 50 years. Let me paint you a picture of what this looks like on the ground. In Shanghai, there's a premium right now. Physical gold is trading $40 to $50 above the London spot price. That's not normal. In a functioning market with plenty of supply, prices should be roughly equal across major trading centers. But when you see persistent premiums like this, it tells you something. It tells you there's more demand for physical metal than there is supply to meet it. Now, I want you to think about what happened in 1971. Nixon closed the gold window, ended dollar convertibility to gold. At that moment, gold was $35 an ounce. By 1980, it hit $850. That's a 2,300% increase in 9 years. But here's what most people don't know about that period. It wasn't a straight lineup. There were moments, specific turning points, where the smart money saw what was coming and positioned themselves before the crowd figured it out. One of those moments was in 1973. Gold had already moved from $35 to about $120. A lot of people thought they'd missed it. Too late, they said. It's already tripled. But then something happened. The Arab oil embargo hit. Inflation started accelerating, and gold went from $120 to $200 in just a few months. The people who thought they'd missed it at $120 watched it more than quadruple from there. I'm bringing this up because I'm seeing similar patterns right now. Gold hit $2,100 in December 2023. A lot of people thought that was the top. It's too high, they said. I'll wait for a pullback. But then it went to $2,200, then $2,300, then $2,400, and now we're pushing toward $2,500, and those same people are still waiting for that pullback. But here's what's different about this move. In previous gold bull markets, you could see it coming in the headlines. Inflation was obvious. Currency crises were front-page news. This time, it's more subtle. The mechanisms are more complex. And that's exactly why people over 55 need to pay attention, because the implications for retirement savings are profound. Let me show you what I mean. The Federal Reserve's balance sheet expanded from $4 trillion in 2020 to $9 trillion by 2022. That's $5 trillion created in 2 years. Now they've reduced it slightly, down to about $7.5 trillion. But here's the thing. That money doesn't just disappear. It's in the system. It's in asset prices. It's in the cost of everything you buy. And if you're over 55, you're feeling this in a very specific way. Your retirement savings, whether it's in a 401k or an IRA or just a regular brokerage account, those dollars are worth less than they were 4 years ago. Not in nominal terms. Your account balance might look the same or even higher, but in real purchasing power, in what those dollars can actually buy, you've lost ground. Now, I want to talk about something that's happening right now with baby boomers. There are 73 million baby boomers in the United States. The youngest are 60. The oldest are 78. And here's what's significant. This generation controls about $76 trillion in wealth. That's more than half of all household wealth in America. But here's the problem. Most of that wealth is in paper assets, stocks, bonds, mutual funds, money market accounts. And those assets are all denominated in dollars. So when the dollar loses purchasing power, when inflation runs higher than your returns, you're not actually preserving wealth. You're watching it erode in real time. I talked to a financial advisor last month. He's been in the business for 30 years, and he told me something that stuck with me. He said, "My clients over 60 aren't worried about making money anymore. They're worried about keeping what they have. And that's the shift. When you're 35, you can take risks. You have time to recover from mistakes. But when you're 65 or 70, you don't have that luxury. You need preservation, not speculation. And that's where gold comes into the picture. Because gold isn't about getting rich. It's about not getting poor. It's about maintaining purchasing power when everything else is losing it. Let me give you a specific example. In 2000, the average new car cost about $22,000. Gold was around $280 an ounce, so you could buy a new car with about 79 ounces of gold. Today, the average new car costs about $48,000. Gold is around $2,400 an ounce, so you can buy a new car with about 20 ounces of gold. Gold not only kept up with car prices, it dramatically outpaced them. Now apply that same logic to healthcare costs, to housing, to food, to everything you need in retirement. The dollar has lost purchasing power. Gold has maintained it. But here's what's happening right now that makes this urgent. We're at an inflection point. The dynamics that drove gold from 1,200 in 2018 to 2,400 today, those dynamics are accelerating, not slowing down. Quick aside here. If you're sitting on $100,000 or more in retirement accounts, I put together a free guide on how gold IRAs work. It's in the description below. It covers how to get physical gold into your retirement account without triggering tax penalties. Worth checking out if that's relevant to your situation. I'll get back to the analysis in a second. So let's talk about what's driving this acceleration. First, there's the debt situation. The U.S. national debt is $34 trillion. Interest payments on that debt are now over $1 trillion a year. That's more than we spend on defense. And here's the math problem. When interest rates are 5% and your debt is $34 trillion, you're paying $1.7 trillion just in interest. That's not paying down the debt. That's just servicing it. Now, how do you handle that? You have two options. You can cut spending dramatically, which is politically impossible, or you can inflate your way out of it. You keep interest rates lower than inflation, so the real value of the debt decreases over time. But that means the real value of your savings decreases too. And this is where people over 55 get caught. Because you're not in the accumulation phase anymore. You're in the preservation phase. You can't just earn more to make up for inflation. You're living on fixed income, or you're drawing down savings. So when inflation runs at 4% or 5% or 6% and your savings account pays 2%, you're losing ground every single year. Now let me show you what's happening with institutional money. BlackRock launched a gold ETF in January 2024. In the first 6 months, it accumulated over $1 billion in assets. That's retail investors, yes, but it's also family offices, pension funds, endowments. These are sophisticated investors who manage billions of dollars, and they're allocating to gold. Why? Because they're looking at the same data I'm showing you. They're seeing the debt levels, they're seeing the central bank buying, they're seeing the inventory drains at the COMEX, and they're making a calculation. They're deciding that having 5% or 10% of their portfolio in gold isn't speculation. It's insurance. But here's what most people don't understand about insurance. You don't buy it after the fire starts. You buy it before. And right now, we're in that window where the smoke is visible, but the flames haven't erupted yet. Let me tell you about what happened in 2008. Gold was around $800 an ounce in September when Lehman Brothers collapsed. A lot of people thought gold would crash along with everything else. And initially, it did pull back to about $700. But then something interesting happened. As central banks started printing money, as bailouts were announced, as quantitative easing began, gold started climbing. By 2011, it hit $1,900. That's a 137% gain from the 2008 low. But here's the key detail. The people who bought gold in 2008, when everything was falling apart, they didn't make the most money. The people who bought gold in 2006 and 2007, before the crisis, they made the most money because they positioned themselves before the crowd panicked. And that's where we are right now. We're in 2006, not 2008. The crisis hasn't hit yet, but the conditions are all in place. Let me show you another piece of this puzzle. The BRICS nations, Brazil, Russia, India, China, South Africa, they're working on an alternative to the dollar for international trade. Now, you might think, so what? The dollar is the reserve currency. That's not changing. But consider this. In 2000, the dollar was used in 73% of global foreign exchange reserves. Today, it's 58%. That's a 15 percentage point decline in 24 years. And it's accelerating. China and Russia are settling oil trades in yuan and rubles. India is buying Russian oil in rupees. Saudi Arabia is discussing pricing oil in currencies other than dollars. These aren't hypothetical scenarios. These are actual transactions happening right now. Now, what does this have to do with you if you're over 55? Everything. Because if the dollar's role as the global reserve currency diminishes, even slightly, the implications for dollar holders are significant. It means less demand for dollars globally, which means downward pressure on the dollar's value, which means your purchasing power decreases. And gold is the hedge against that. Because gold isn't anyone's liability. It's not dependent on a government's promise or a central bank's policy. It's a physical asset with 5,000 years of history as a store of value. Let me give you another historical parallel. In 1980, gold peaked at $850. Then it entered a 20-year bear market, bottoming around $250 in 2001. A lot of people who bought gold at the top in 1,980 felt burned. They watched their investment lose 70% of its value over 2 decades, and that created a whole generation of investors who were skeptical of gold. But here's what's different now. In 1980, interest rates went to 20%. Paul Volcker, the Fed chairman, broke inflation by making the cost of money so high that it crushed demand. That's not happening this time. Interest rates peaked at 5.5%, and the Fed is already talking about cutting. They can't raise rates to 20% because the debt service would be impossible. The government would default, so we're in a fundamentally different environment. In 1980, the Fed had the tools and the political will to fight inflation aggressively. Today they don't. They're trapped. And that's why this gold move is different from previous cycles. Now, let me talk about something specific to people over 55, Social Security. The average Social Security benefit is about $1,900 a month. That's $22,800 a year. Now, think about what that buys today versus what it bought 10 years ago. Groceries cost more, gas costs more, healthcare costs more. Your Social Security payment might have a cost of living adjustment, but it's based on CPI, which understates real inflation. So if you're relying on Social Security as a significant part of your retirement income, you're already feeling the squeeze, and it's going to get worse. Because the Social Security Trust Fund is projected to be depleted by 2034. That's 10 years from now. When that happens, benefits will be cut by about 23% unless Congress acts. Now, I'm not saying Social Security is going away, but I am saying that the purchasing power of those benefits is declining, and the political solutions being discussed all involve some combination of benefit cuts, tax increases, or means testing, none of which are good for retirees. And this is why gold matters, because it's one of the few assets that maintains purchasing power over long time horizons. It's not about timing the market perfectly. It's about having a portion of your wealth in something that isn't dependent on government promises or central bank policies. Let me show you what's happening with mining supply. Global gold mine production peaked in 2018 at about 3,300 tons. Since then, it's been flat to declining. We're at about 3,100 tons now, and here's why that matters. It takes 10 to 15 years to bring a new gold mine online. From discovery to production, you're looking at over a decade. So the supply that's available today was discovered 15 years ago. And the discovery rate has been declining. Major new gold deposits are becoming rarer. The easy gold has been found. What's left is deeper, lower grade, more expensive to extract. Which means even if gold prices rise significantly, supply can't respond quickly. So you have declining supply, or at best, flat supply. And you have increasing demand from central banks, from institutional investors, from retail investors in Asia. That's a recipe for higher prices. It's not speculation. It's supply and demand. Now let me address something I hear a lot. Gold doesn't pay dividends. It doesn't generate income. Why would I own it? And that's a fair question. But here's the counter. What good is a 3% dividend if inflation is running at 5%? You're getting income, yes, but you're losing purchasing power. You're going backwards. Gold doesn't pay dividends, but it also doesn't have counterparty risk. It can't be inflated away. It can't default. It can't be hacked. It's physical, tangible, and it's been valuable for thousands of years. That's a different kind of security. And for people over 55, security matters more than yield, because you can't afford to take big losses. If you're 35 and your portfolio drops 30%, you have time to recover. If you're 65 and your portfolio drops 30%, you might not recover before you need that money. Let me tell you about a conversation I had with a 68-year-old retiree last year. He had about $800,000 in his retirement accounts, all in stocks and bonds. He was getting nervous about market valuations, but he didn't know what to do. His advisor kept telling him to stay the course, that timing the market is impossible. So he did nothing. And then the market pulled back in late 2023. His portfolio dropped to about $680,000. That's a $120,000 loss. Now, the market has recovered some since then, but he's still down. And here's what he told me. He said, "I can't sleep at night. I'm watching my retirement disappear, and I don't know what to do." That's the reality for a lot of people over 55 right now. They're watching their savings fluctuate wildly, and they're realizing that the traditional 60-40 portfolio, 60% stocks, 40% bonds, doesn't provide the stability it used to. Because when inflation is high, both stocks and bonds can lose value at the same time. And that's where gold fits. It's the diversifier. It's the asset that tends to move inversely to stocks and bonds during periods of financial stress. It's not perfect. Nothing is. But it's a tool that can reduce portfolio volatility and preserve purchasing power. Now, let me show you what's happening with physical demand. In India, gold imports in 2023 were 1,100 tons. That's the second highest on record. In China, gold demand was 1,089 tons. These are massive numbers. And it's not just jewelry. It's investment demand. People in Asia understand gold in a way that people in the West often don't. They see it as essential savings, not as a speculative investment. And here's what's interesting. As wealth grows in Asia, gold demand grows with it. China's middle class is expected to reach 1.2 billion people by 2027. That's 1.2 billion people with disposable income and a cultural affinity for gold. That demand isn't going away. It's structural, not cyclical. So you have this massive demand base in Asia, you have central banks buying at record levels, you have supply that's flat to declining, and you have a monetary system that's creating more dollars, euros, and yen every year. All of those factors point in one direction: higher gold prices. But here's the thing. It's not just about higher prices. It's about what those higher prices represent. They represent a loss of confidence in paper currencies. They represent a shift in the global monetary system. They represent a recognition that the old rules don't apply anymore. And if you're over 55, you need to understand this shift, because it's going to affect your retirement in ways that might not be obvious right now. Your savings, your income, your purchasing power, all of it is tied to a monetary system that's under stress. Now I want to talk about timing, because a lot of people ask, is it too late? Has gold already run too much? And here's my answer. If you're buying gold as a speculation, trying to time the top and bottom, then yes, timing matters a lot. But if you're buying gold as insurance, as a hedge against currency debasement and financial instability, then timing matters less. Think about it this way. If you buy homeowners insurance, you don't try to time it perfectly. You don't wait until fire season to buy coverage. You buy it and you hold it because the cost of being wrong is too high. Gold is similar. The cost of not having it, if the dollar loses significant value, is potentially catastrophic for your retirement. Let me give you one more historical example. In 1971, when Nixon closed the gold window, gold was $35 an ounce. By 1974, it was $195. That's a 457% gain in 3 years. But here's what's interesting. In 1973, gold pulled back from $127 to $90. A lot of people who were waiting for a pullback got their chance, but many of them didn't buy because they thought it would go lower. And then it went to $195. The point is, waiting for the perfect entry point often means missing the move entirely. And for people over 55, missing the move could mean missing the opportunity to protect your retirement savings during a period of significant monetary instability. Now, let me bring this back to what's happening right now. The COMEX inventory situation I mentioned earlier, that's not resolving. It's getting worse. In the last 3 months, registered gold inventory has dropped another 12%. We're now at levels that historically have preceded significant price moves, and the central bank buying isn't slowing down. In July 2024, central banks bought 37 tons. In August, 42 tons. This is consistent, persistent demand from the largest, most sophisticated buyers in the world. They're not buying gold because they think it's going to double next month. They're buying it because they're preparing for a monetary system that looks different from the one we have today. And that's the message I want you to take away from this. If you're over 55, you're in a unique position. You have accumulated wealth, but you also have limited time to recover from mistakes. You need to be thinking about preservation, not just growth. And gold is one of the most effective preservation tools available. It's not about putting everything into gold. It's about having a meaningful allocation. 10%, 15%, maybe 20%, depending on your situation. Enough that if the dollar loses significant purchasing power, you have a hedge. Enough that if we see another financial crisis, you have stability. Enough that you can sleep at night knowing that a portion of your wealth is protected. The shift that's happening in the gold market right now, the inventory drains, the central bank buying, the supply constraints, the demand from Asia, all of it is pointing toward a repricing of gold relative to paper currencies. And that repricing could happen gradually over years, or it could happen suddenly in a matter of months. We don't know the timing, but we can see the setup. And if you're over 55, you can't afford to ignore this. Because the decisions you make in the next few months could determine whether your retirement is comfortable or whether you're struggling to maintain your standard of living. This isn't fear-mongering. This is looking at the data, understanding the trends, and making informed decisions about how to protect what you've spent a lifetime building. The gold shift is real. It's happening now. And it could affect you directly in ways that become clear only after it's too late to position yourself effectively. Don't be the person who looks back in 5 years and wishes they'd paid attention when the signs were obvious. The time to act is when you have options, not when you're forced to react to a crisis.